There are many kinds of Tesla investors. Some are buy and hold who see Tesla as a once-in-a-generation company. Others trade around the volatility because disruptive technology never moves in straight lines. We have a very special CyberBulls today where we'll ask and debate the following questions. If you're buying Tesla stock for the first time, what's a single rule that actually matters? Looking back at your Tesla journey so far, what's one decision you got right and one you got wrong? For those who've used the options, what lessons hurt the most? What lessons gained you the most? Pretty sure you'll hear something today that changes how you think about investing in Tesla. So we've got the bulls here with us today. We got the bot bull, the master forecaster, the slayer of spreadsheets, Cern Basher. We got the options bull, the froyo tycoon, Xander Sky, and the young prescient bull. He believes in investing against the grain, Nicholas Gibbs. Welcome, everybody.
Hey, Herbert.
Hey.
Okay, so thank you very much, guys. This is a great show that I've been wanting to do for a while because remember how you, Xander, the way actually when you and I started this show a long time ago, the first reason we thought this was good was because we all had different investing styles. And right, that's fine. Everybody should have their own model. They should do what feels comfortable for them. But so I thought it was really, interesting to hear what you do, what Cern would do, what Nick does, and how we all differ a little bit. So first question to you, Xander, like I know that your style has actually changed. What belief did you have when you first started investing in Tesla that then you actually changed and you no longer believe today? The company and the product. I don't look at the quarterly stock movement.
A very realistic bull, questioning certain decisions.
The rational bull. I enjoy listening to bears.
Looking for the red flags. You're supposed to react.
The longer term opportunity for Tesla is like no other company that I've ever seen.
Yeah, it's evolved tremendously. When I first started, I was a classic S&P 500 index fund investor and total stock, total international. I had some bonds, and then I had to unlearn all of that. I started buying Tesla. I went all in, so sold my houses, but went all in, and then bought some leaps, and those did very, very well. But that whole long-term capital gains lesson really bit me in the tush there, because I ended up with leaps that expired worthless because a year later they were down, and I just didn't, I had hopium and I just thought, oh, it's going to come back up. But of course that drawdown from 400 or 415 down to 100 hurt a lot. So I think about those early lessons with Christian, and even before the show started, where I asked him a lot of these kinds of questions, and he always said you don't want to sit through a drawdown. So I think trimming is very, very important if you're you're relying on any part of the income. You can generate income if you're retired off of your shares or your position by selling covered calls. They don't have to be super dangerous ones where your shares are really at risk. Obviously, you never know when a stock is going to run. But for me, what's really, really changed is that once I discovered the wheel strategy, which is selling cash secured puts, which is basically a limit order to purchase stock at a predetermined price and a predetermined date, by a predetermined date. And then if you get assigned, to be able to sell those shares, because as soon as you get assigned, you start selling covered calls. And wheeling that money showed me that I could manage cash and have a predictable income for my life. I don't need a 9 to 5. If you have enough, enough skin in the game, you can really do well with that strategy. And then, so I just discovered that buy and hold, it really isn't for me just all in or all out. I've become very compartmentalized. I'll have a long-term strategy. I'll have a really short-term options portfolio, a Roth IRA, like a business partnership account where I can't take too much risk. So all of those things have kind of led me down this path to where I'm better off managing my own capital and being, as Nick likes to say, capital efficient. And so I'll leave it. I'll land the plane there.
Gotcha. So you started off as a buy and hold, and then you said, "Hey, there's different strategies, and I'm willing to sell but pieces of what I've owned, and you manage it." How about you, Nick? What are you doing today? What's your philosophy?
Yeah, so much like Xander, I've had a evolution, I guess, in the way I invest, and I think that only makes sense to evolve and to add more tools to your toolbox and have more strategies at your disposal. So, when I first started investing, I unintentionally was contrarian to begin with. It was just because I started investing when I was 14 years old. My father opened up a brokerage account for me. So it was my custodian account. And back then with Fidelity, you had to have $2,500 to open an account. And that was money I saved for a car. But instead, we opened up that account, and there's rumors about this phone, like an iPod thing that Apple was going to come out, the screen that you can touch. And so I just put all my money into Apple. And from there, eventually I sold it all out of Apple. I nibbled a little bit here and there, and then I discovered Amazon, went all into Amazon, and then I went all into Tesla. And so it kind of just out the gate was kind of contrarian. I never really believed in the idea of diversification. And I mean, even the greatest investors in the world, you can go see, there's plenty of, videos and interviews with Druckenmiller, Warren Buffett, Charlie Munger, right? I mean, you can see the best investor, Elon Musk, right? Arguably the best investor in the world. The best investors don't really diversify. They kind of go all in. And I'm not saying that's for everyone, but I think it should be for everyone, that kind of mindset to really understand what you're investing in. And so where I would say that my investing has kind of shifted is learning options. I started just trying to learn options starting back in, I guess, like 2015, where I didn't even understand what it was. I bought a book just to try to understand what it was. And it literally took like 3 years probably to actually understand what a call option mean, how do the contracts work, the understanding of what they control, because I'm just sitting there being self-taught. At the time I worked out in the middle of the ocean, took a helicopter to get to my job out there. I worked for Shell and BP as an engineer. And that's ironic. I wasn't working. When I wasn't working, I'd be sitting there reading this book that I didn't even understand half the words in there, and there's no ChatGPT or Grok. But over, I guess, the last decade, I like to think I've mastered the concept of options, and it's allowed me to, if you're a buy and hold Tesla investor, you made about 13% this year. Me and my best friend Greg, and I'm sure Xander has something similar, we all made 40 to 50% return on our portfolios this past year. 100%, and the reason I think it's so important is because there's two buckets of people. There are people who hear what we're saying and they're like, oh, there's something interesting there, and they want to dive deeper. And, we've talked about the crash courses I run. So, that's what that's about for those people. But then there's other people who say, oh, it's just gambling and all this. And to me, yes, you can look at it as gambling, but then everything's gambling. It's no different than putting your money into a Nikola or a Lucid or a Rivian. It could just as easily go to zero. The statistics are the same. In fact, they're not. With options, that contract's going to go to zero at some point. You don't know that with the stock. You at least know that with the option, which at least what can happen and you're on guard for it. But the other problem I have with people who are against options or are just a buy and hold mentality is that if that's all you do, then let's say you have a 401k, you do all the right stuff, you put your money in the S&P 500 or in Tesla, whatever, you just put it in there and you leave it and you forget it. By the time it's time for you to retire, two things are going to happen. Either one, no more than you did when you open up those accounts because you haven't invested in your knowledge. You haven't actually been in there and practiced and made mistakes and learned from those mistakes and become a better investor. That's one. Or two, you're going to retire at a lot later age because you don't understand that you can be more capital efficient. Like Xander was saying, you don't need a 95 because you have a big enough portfolio where you can live off of it very safely using what I would consider a no risk strategy. So anyways, I'll pause there not to drag this out because I feel very passionate about this, that people need to learn. And yes, you will lose money learning because nobody makes every shot they take, but that's the process. And you want to make those mistakes, or you want to learn those lessons sooner than later, because ideally you learn, you get better, but also to allow yourself to live more life than just be stuck in the same, rat race everyone does. The 401k was invented for a reason. You're at 9 to 5 for a reason. You retire at 60 something for a reason. There's another way.
Okay. No, fantastic. So both of you guys have done incredibly well. And I know that's a fact because you guys have studied it. You live it every day. You learn, like you said, and you are not afraid of options. And what you're saying is people should not treat options like as if it's the gambling and it's the devil. Having said that,
can I just say something real quick, Herbert? One, let me just address the black nails, everybody, in case you're wondering.
I was about to ask.
Yeah, this is from a New Year's Eve rock star theme party, and my wife hasn't given me the stuff to take it off yet.
Today, yeah.
So that's one. Before you guys are like, who is this idiot? But number two, I don't know how much I can stress this. People like to discredit the things they don't know, or they like to just bucket things as gambling. But just know this, even gamblers, there's a skill to it and a strategy to it. If I put you at a table with Phil Hellmuth or Daniel Negreanu, you're going to lose. Why? If it's just gambling, it's all just luck.
Yeah.
Then but that's not, right? Like there's strategy, there's statistics, and options don't require luck.
But not everybody is going to be, professional gambler, and this is not gambling, is what you're saying. But my point is that we all agree. There's so many different kinds of people out there.
Before we go to Cert, I want to add something that is really important. What changed my mind about options was a statement that was made to me. It's like there's like options selling is completely different than options buying. I'm not the gambler in the casino. I am the casino. I'm the guy that's writing the contract to the counterparty, to the gambler, that says that Tesla's going to go to 200 in the next year. Well, I'm happy to buy shares there at 200, so I'm happy to write that put contract and make some premium on it. So just understanding that concept, that there's a difference, it is just completely sets you free, and then it's worth investigating further.
Yeah, there's different kinds of options. Okay, Søren, let's get to you. What's your investing style and philosophy?
Well, I think rather than discuss my own personal one, I guess I'd kind of broaden that a little bit and just say that I think there are many different pathways for people to approach investing. I've been a professional investment advisor for 30 years, so I've seen a lot of different approaches. People have come to me with different ways that they've done it. And I wouldn't say that there's any one right way. That's not true about anything, right? Whether it's diet, whether it's exercise, whether it's anything in life, right? There's more than one pathway. But I think the most important thing is to make sure you understand what pathway is right for you, right? And people are going to approach this differently. And that's great. They really should. The disconnect happens, I think, when you're not clear about what you really want, or your expectations are not consistent with the pathway that you're on. And a lot of people, try options, they go down a certain path, they lose a lot of money, they have a bad experience, and then they leave it behind. You have to be very, I think, methodical and very careful about how you approach option investing. Kind of dip your toe and learn the ropes, learn the different strategies over time. And so I would just say this at the outset, I'm not opposed to options. I think they're fantastic tools. It's like any tool, right? In the right hands, a tool is a marvelous thing. But put a hammer in a baby's hand, you're going to have a problem, right? Even a tool like a hammer, much less a skill saw or some other thing that they could actually, do some damage with. So it's exactly the same thing, I think, with financial instruments. And in my experience, that's where the massive disconnect tends to be, is that people just don't know what to do with these tools.
I think I couldn't agree more with that, Søren. I think the way you said it is perfectly. I think people learn, I can buy a call option and I can put $1,000 and I can make a return of 100x or infinite. And that's it. That's as far as their education goes. And they don't look into anything else about it. They don't understand what goes into the pricing of the option. They don't understand the risk associated with it. they're selling these, or they're buying these far out of the money options that statistically have a like 1% chance of hitting. They don't understand time decay. They don't understand volatility. They don't understand the Black-Scholes model. And yeah, exactly. You're literally putting a hammer into a baby's hand. And that's the whole reason why I started teaching these courses, is because I saw so much of that in the Tesla community, and it starts to make you feel gross when you understand something and you see these people keep making these mistakes, and you see these people posting on X that's just heartbreaking post. And at some point it's like, well, you either got to stand up and do something about it and try to make the world a better place, or just sit there and keep feeling bad about it.
I think there's one thing I think that is worth mentioning here, that I'm all for people taking the responsibility of investing in their own hands. I think that's an absolutely awesome thing. All right. One of the challenges, though, I think that when you're investing for yourself, particularly if you're spending a lot of time on it, right? If this is your quote unquote job, that it's kind of nice sometimes to have the diversification of income, right? If you have a professional job and you walk away from that, and then you're trading options, trading stock, whatever you're doing, you've just in that sense increased the riskiness potentially of your financial situation, right? If you have an income coming in from something else, that is some diversification to perhaps an all-in or almost all-in strategy, or a very focused or concentrated strategy investing in stocks or options. So that's one thing to think about too. And then of course the other thing is you have to factor in the return on your time, right? If you don't have an income, a source of income coming in for the time that you're putting in, and you're just making money from your investments and all the time that you're spending on that, it's one thing to say, I had this return last year when a buy and hold investor had this other return, but you have to take into account the fact that there's value to your time, right? And it's not just a percentage return, right? And that's where it gets a little tricky to measure, right?
Can I push back on that a little bit?
Sure.
You're right. You can think of it that way, as a return on your time. But the real question is, if that person doesn't spend that time trading or investing or learning, how else would they have made extra income? Most people don't have another way to make more income. So that return on time is a theoretical thing that doesn't actually exist, because these people wouldn't have another job anyways to go to. So your return on time is spending less time sitting there watching TV, getting dumber, or sitting there scrolling on Facebook or on Instagram during your break, when you could be sitting there learning something and getting better at something during those times, using up that slop time that you have.
Fair point.
Yep. If it's your interest. So there's obviously many different people. There's people.
Everyone's interest is making money. Let's be clear about that. That was the other thing. You said there's no right way or wrong way to diet or make money, but no, there is a right and wrong. Making money, stacking more money is the right way.
But there's ways to make money.
Losing weight is the right way.
Like instead of options, again, we're not saying options are wrong. I'm just saying some people prefer to spend time building a business and different businesses and side hobbies, those kind of things, and others. They're more interested in that than learning about options. But yeah, and then just.
But as long as they're doing it, is what I'm saying. That's the only way it's apples to apples.
Are 100, like Xander, you're 100% full time on managing your money, and then Nick, you've got another job, a full time job, and then you do managing your.
I got a lot of things going on. Yeah,
lots of things. And then CERN is a financial advisor, and of course he manages not only himself but other people's money. And then of course I've got my day job here and others, and then I've got my investment as well. So everybody has their different scenarios and different opinions. CERN, did you want to go through your deck that you sent me?
We can certainly, just to set the stage, I think, for Tesla investors. This is kind of a nice little table that shows the calendar returns since the IPO. That fourth column shows the annual change. So in 2010, the stock was up 57% in that half year that Tesla was a public company, right? And then in 2011, it was up 7% and so on down. 2013, up 344%. There's been a couple of negative years for Tesla, 2016 down 11 and 2022 down 65. Xander was talking about that period for himself personally. Last year, the stock was up 11%. And then what's really interesting, I think, is the last column, the annualized numbers. So that top number of 47%, if you bought that on the day of the IPO, at the close of the IPO date, you've compounded at 47% per year since then. If you bought and held. If you bought it in the start of 2011 at effectively $1.78 a share, split adjusted, that's a 45% annual compound return. So each year you go down, it shows what that annualized return is to the present. So if you were in the stock, for example, since 2020, beginning of 2020, you've compounded at 59% per year. So this is kind of one way to look at those numbers. So fantastic returns just for the simple, boring strategy of buy and hold the shares. But as we all know, there's some periods in here where it's not been fun to just hold a stock. Quite painful, actually. And that's not uncommon, really, with any company, whether it's NVIDIA, Tesla, or some other company. Even the S&P 500, even a diversified fund, has similar challenges. This is the visual of the stock chart. That you look at this chart, and obviously it would be very tempting to say, well, yeah, I'd like to sell high, I'd like to buy low. I think I can do that. And there's no doubt that there are some people and there's some strategies that can be employed to try to capture some of those bottoms and sell some of those peaks. Not an easy thing to accomplish necessarily, but there's definitely some strategies out there that put the odds more in your favor. And then on the next page, Herbert, is the compound growth of this being in the Tesla stock, what it means in terms of dollars. We showed the percentages on the first page. This is dollar terms. You put $100 in at the IPO, it'd be worth over $30,000 today. And if you just put it in the S&P, it would be worth almost 900. So an incredibly massive difference in compounding between the two investments.
Can I add to that? If you do analysis of all the M2 money supply that's been increased, that is 874 is actually flat.
Yeah.
Interesting. Yep.
Yeah, we're not taking into account inflation here, or as you point out, money supply growth. And that's a very important consideration. Yep. That line almost looks flat, Nick, as it is, right? But,
yeah, exactly.
Yeah. Now, this next one I think is really interesting for people to think about, and particularly perhaps for traders, particularly day traders or option traders. This is something that is not unique to Tesla, but it's very clear here. All of the returns in Tesla stock since its IPO have come overnight.
Wow.
If you would have just simply followed a strategy, and I wouldn't recommend this because the trading costs would be challenging, but if you had a strategy of buying at the close and selling at the open, you've captured all the return of investing in Tesla. If you only bought at the open and held for the day and sold at the close, you actually have not compounded your money at all. All right, $100.
Fascinating chart.
That red line, it hasn't really gone anywhere. In fact, for most of this time period, the red line, you've lost money by doing that if you just held for a day and then closed out your position.
So, CERN, what do you do with this information? Are you selling everything and buying everything?
No, the lesson for me, Nick, I think, is that don't try to, for the most part, don't try to game this, because most of the returns are going to come overnight when the market's closed.
Yeah, don't get cute. That's what I always tell people.
Yeah. Yep. And it's interesting that the fact that there's no return during the daytime is probably because there's all these people that are buying and selling during the day. They're trading. And so all the returns kind of cancel each other out. There's no new information that's learned during the day. Most of the information that's released that's new for the company, or really all of it officially, is released after hours. There's a reason that they wait until the market closes before they release their earnings. Or this morning, the production and delivery report was released before the market opened, right? And so the stock reacts before the market opens. It gaps up or gaps down. Yeah, this is a fascinating chart. It's important for stock investors to understand this, as most of the returns do not come during trading hours. Yeah, and this is consistent with NVIDIA and other companies as well. The next chart, Herbert, is just a drawdown chart. Again, for a buy hold investor, this is pain. This is your pain threshold right here. Right? There are times Tesla's been down, over 70%. It's not uncommon to be down 35, 45, 50% if you're a buy and hold investor. So this is why it is tempting to try to avoid some of this pain. Each one of these red lines that goes down is kind of like a dagger in the heart at times. It's really painful. So I understand the temptation to try to avoid this pain. It's a natural human tendency, right? When you put your hand on the hot stove, take it off. Well, this is the hot stove of investing in Tesla stock right here. And then the next page is the number of trading days between new highs, right? Sometimes it takes a while before the stock hits a new high. And as a buy and hold investor, you can get kind of impatient if you're waiting 600 days or more between new highs, right? And so again, it's hard actually being a buy and hold investor. It's a really hard thing to do. A lot of people say, well, that's the default. That's really simple. Actually, it's not. It's actually quite difficult to have the courage of your conviction, to have the control of your emotions, to be able to hold something during long periods where it just does nothing or goes down 70% at times.
To add to that too, Tesla is one of the easier companies to hold in that type of period. Microsoft was sideways for almost a decade. Tesla, at least we are part of the FSD testing. We get it. We can see what's happening. That helps us keep conviction because we get to use the latest software that's supposed to have this huge upside for us. Yeah. But in any other company, you don't really have that, which makes it even harder. So Tesla, in a way, is the easiest for that reason.
It's a good point, Nick. And also with Elon and the information flow that comes from him, every day he's posting on X. I mean,
yeah, he gives you hope to hang on, right? Yeah. To keep it up. You don't hear from Sasha. You don't hear from Sanjay. You don't hear from Andy Jassy. You don't hear from Tim Cook. You don't hear from any of them. Just Elon. He's literally the only CEO.
Yeah, maybe Jensen is up there in terms of information flow from him, but not in the same way that Elon does, for sure.
Yeah.
Yep. Good point. And then further to illustrate this point is the time below the high. So 88% of the time Tesla trades more at 5% or more below its high. So only 12% of the time it's trading within 5% of its all-time high. 10% or below, 78% of the time it's trading 10% or lower. 64% of the time it's trading at 15% or lower from its high, and so on. 30% below its high, almost 30% of the time. So as an investor, you need to understand, the message from this is you understand that a lot of the time, if you own the stock, this is going to be trading well below its high. And that's just normal. The chart for NVIDIA looks almost exactly the same, and other companies. Okay. And then this is the snapshot, kind of a 7-day snapshot of leading up to when Elon decided to invest almost $1 billion in the stock on September 12th, right? And you can see price action there. You can see a little gap up there on September 5th, right? Between the close of the previous day and then the open. And then it was flat for 2 or 3 days and started to move on the 11th, the day before Elon started buying. And then the day that he bought on the 12th, stock went straight up. So this is, I think, a cautionary tale for people that are trading, and that you could easily miss these gaps, right? If you're not in the stock, if you've closed out your position the night before, and then you find out the next day it's gapped up. So this is where, potentially a buy and hold investor has an advantage, but of course it also works in reverse. The stock can gap down. And so you might be very happy that you'd closed out your position the day before. But this is common. Stocks are going to have these kinds of moves. Now, a CEO buying almost $1 billion of his own stock is not a common occurrence. But the message here is that Tesla behaves like this all the time. This creates opportunities, obviously, for shorter-term traders and investors, but also risks. I thought that was just an instructive one to look at. And then, as we've talked about before, Herbert, I've looked at the best 100 days for Tesla. The best day was May 9th, 2013. It was 24% in one day. We've had a number of other best days over the last couple of years. I forget which is which, but the green and the red represent the last couple of years. So just in the last 2 years alone, we've had a number of the top 100 days in Tesla stock. If you miss one of these days or some of these days, your long-term returns will be materially impaired, right? Now, you can also do the worst 100 days, and the chart's similar. It's like the inverse of this. I don't have it here, right? And so as a trader, if you can avoid the worst days, then great, you're better off. So it's tempting, but it's also a challenge. And then next chart is just a scatter plot of the daily stock returns. This is the heartbeat, I suppose, of Tesla. Really, any stock, but there's just a lot of noise here.
Yeah.
Get
then
stuck
lastly,
there for a
Herbert.
second, looks like.
Yeah.
Yeah. Lastly, Herbert, this is just the sort of the histogram, I guess, of the daily returns, and only about, there's very few high return days. Most of the returns are clustered around that middle where it's between, let's say, 4 and -4%. This marking time, the stock's just bouncing around doing absolutely nothing.
So didn't you have a table that said only a certain number of days, 42 days or something like that
Yeah.
the stock went up, and if you had held it on just those 42 days since 2010, you would have made all the gains. But the trick is, how do you know which days is going to be one of the 42 days?
Yeah, right. It's they call it 4,000 trading days, and you only needed 40 some days. Good luck picking the 40 some days, right? It's pretty tough.
Can I add to? Oh, go ahead. I'll let you finish.
Well, just a closing thought, Nick. I guess my main message with all this is there's opportunities and all that for shorter term trading strategies, right? There's also risks. And then, of course, for buy and hold investors, the opportunity is if you don't sell, then you don't miss any of the great days, but you experience all of the bad ones. So you really just have to decide which strategy fits with your own investing mentality. There's pros and cons to each. Neither one is perfect.
Yeah, so I just want to say a couple things just because of how we started this conversation talking about options. And I don't want to speak too much for Xander, but I'm pretty sure he's going to agree with what I'm going to say here. I'll let him come in and clean up anything I say. But when we're talking about trading options to be more capital efficient on top of your portfolio, we're not talking about just doing it on Tesla. So just to be clear. So it's not like everything we're doing is on Tesla, right? I trade Meta, Nvidia, Apple, AMD. I go where the opportunity is. A lot of times that opportunity is in Tesla as well, but I go where the opportunity is. So that's one thing, just to make it clear. The second thing, and Xander pointed out very well, and this is kind of the base of everything that I teach in our course, is that the majority of what we do is selling options. So being the insurance company, being the casino, not necessarily buying. When you buy, you're timing the stock and you are predicting a price. When you're selling options, you're doing the inverse of that. You're not trying to time anything. You're not trying to predict any price. If anything, you're saying, hey, Mr. Market, you got to come and beat me. I'm not going to try to beat you. It's the other way around. And so that is just proportionally different, right? It's like being the person selling the lottery ticket and saying, hey, CERN, you bought that lottery ticket. You got to come and beat me by guessing these numbers right. I'm not going to try to beat you. Go for it. Buy your $1 ticket and you might make $1 billion, but I don't think you're going to. I think the odds are against you. But if it is, great. So that's the second thing. And then the third one is, I love the charts that you put out there, CERN, because especially when you talk about these these overnight moves that are on the upside, that's where if you know how to sell covered calls, and I don't just mean, do you know how to go into your brokerage and sell a covered call? Do you know what to look for from a option chain point of view, from a statistical point of view, from a volatility point of view, from understanding where the stock is? Do you know when to sell covered calls versus not, whether it's on Tesla, whether it's on Nvidia, Palantir, or anything? It can allow you to really benefit from those moves. For example, right now, look, maybe a week ago, 2 weeks ago, I guess 2.5 weeks ago, we touched 490, 495 or 498. We're almost at 500. And if I would have told all of you guys, hey, sell some 550 covered calls, everybody would have been like, oh, no way, I don't want to give up, I'd lose my shares. Today, every one of you wish you did that. Well, if you thought about it, right? And I think that's part of like what CERN was saying before about a baby with a hammer, is that you have to understand what you're doing. So if you're going to sell a covered call, you can't be selling a covered call with FOMO. You can't be selling a covered call, and then we get to 520 or 530, and now that covered call is looking red, and all of a sudden you decide, oh, I'm just going to close this out because I don't want my shares to get called away because I'm too emotionally tied to my shares. That would be a stupid thing, because when you sell a covered call, all you're doing is selling high. You really can't hurt yourself other than having FOMO. And so I think CERN's charts really depict that in a very good way, but especially how when we have such extreme movements in Tesla stock and when we're at such high inflection points where it can be a good time, if you know what you're doing, to sell covered calls. Or if the inverse, you're at a very extreme on the downside, it could be a good time to sell some cash secured puts, right? Just depending on what you're doing. But that's where I think the strategies are really beneficial for you to help you dollar cost average better, or to help you sell high so you can potentially buy low later.
Can you guys talk a little bit about that? Maybe both sides here of what advice do you give to people to manage their emotions? Because I think most people would understand that most bad decisions happen in investors. They just because they get caught up. When the stock fell to 100, I guess it's different, but when it started to fall from 300 to 250, when it fell from 250 to 200 to 150 to 100, at each stage, people kept saying, oh my God, the world is falling apart, I better sell. And then, of course, there's those who sold everything at 100, and of course, very quickly, once it goes back up again. So how do you manage the emotions?
It's a great question. I mean, I'll tell you just from and this isn't just a trading perspective. This is also my stock portfolio, right? I trade on top of my stock portfolio. I use my stock portfolio to be able to trade. So one, I would say, stop trying to not be emotional. I hate when people say like, don't be emotional. It's like, it's impossible. If Tesla goes up $100, I'm going to be happy. Like there's no one way, like there's no two ways about it. I'm going to be happy. And guess what? Right now, when we're almost at 500 and we're down here, like it sucks. I'm not happy about this. Like I wish we were going higher. I want to break 500. I want to see us move up. Like emotions are human. So don't try not to be human. Now, with that said, that's where, stoicism can come in. Understand you have emotions, feel those emotions, but those emotions should not get in the way of logical decision making. And so whether you're just a buy and hold investor, whether you're a trader, doesn't matter. Once you put your money out there, you should have two things. One, a strategy, and understand what your strategy is. And that strategy really shouldn't change much because you had a plan, stick to your plan. But two, you need to have mechanics on what to do if you start to get in trouble. And that's what we spend a lot of time in our crash course talking about is everyone knows how to place a trade. Everyone knows how to buy stock. It's so easy. In fact, that's what all YouTube is right now, is just telling people what to do to get into things. But you know what they don't tell you? How to take winners and how to manage your losers and how to lose fast and protect yourself and have mechanical defensive strategies in place, what to do, right? Do you know how to cut your deltas in half? Do you know how to roll down the untested side? Do you know how to buy the guts and sell the wings? Do you know how to turn if you bought leaps, do you know how to turn that into a vertical so that you can at least have some of that, if you buy the call outside in the same strike, same expiration, do you know how to sell calls there that are essentially covered by your long leaps? Do you know how to do that so you can offset the cost of those leaps in case those leaps are going to go to zero, like what happened to Xander, right? Hey, he went to zero. He could have not gone to zero. He could have at least recovered some of that money. So if you don't know these strategies, then you're probably a baby playing with the hammer, like CERN said.
Yeah, great points, Nick, and CERN. Those slides are amazing. When I'm watching those slides, I thought about my kid who has some stock that was purchased in 2020, and that's the best trader in the house over the long time horizon, right? Because they didn't do it. He can't touch it. And I can't touch it because it'll be a taxable event. So, and I have very close friends that are, bought IPO and, they have the 30,000% or the, 25,000% or whatever it is now. So it's definitely, there's definitely merit to this counter argument. But I think the point that Nick and I are trying to make is that, like, if you're able to outperform the underlying stock over a long enough time period, maybe being concentrated is actually like too concentrated, like as an all in or all out, which is the common thing that I hear. I just realized that I can't be all in and all out. I have to have a portion of my portfolio available to hedge, whether it be buy some puts because there's some bad news comes out, be able to buy the dip or whatever. So what Nick was saying regarding waiting till 500 to sell some covered calls, like that is when IV is the highest. That is when your like the risk of being in like margin is absolutely the highest. And what's funny is everyone just does the complete opposite. You know that photo of the Tesla at 225 and Tesla at 450, 2-for-1 stock on this side, there's nobody in line, one for one there. And that's what people do. And so I kind of just learned to flip everything on its head. If 9 out of 10 options expire worthless, do you want to be a buyer of those options or do you want to be a seller of them? I discovered, statistically speaking, over 2 years, actually it's almost 3 years, but the 3 years ago I was a B student. And prior to that, I was a C student with like 70%. But currently my options and my trades are, for the last 2 years, are greater than 90%. And I could, I've shown it to people. And so what does that mean, right? It's can you outperform the actual stock? And as I mentioned, it's not a brag, but this year, my portfolio is basically, I've recovered all of the damage that I did with those leaps, which I just consider as the cost of my education. And I've always had this philosophy of learning on small amounts of money, because if you can get to the point where, the decision to enter or exit a trade is the same, whether you're doing one options contract selling or if opportunistically buying, you can really get ahead. There's people like Stock Talk that post their returns over the years, and it's like hundreds of percents of returns. Now he's a very deep research, and he buys the underlying stock, but then sometimes he does options, and the gains are just phenomenal. So I don't look at those people and go like, oh, well, I can't do that. I go like, well, how are they doing it? What are they doing? I fell in love with options because of like Emmett Peppers and what he did around the S&P inclusion trade. And so I just went like, what is this mechanism that exists in trading with options? Why are there puts? Why are there calls? What are these fancy butterflies and iron condors that I couldn't tell you? I couldn't explain it to you. I don't even use the Greek. So, I'm just like a person who experimented with a bunch of stuff, and then the result ends up speaking for itself. So the last thing I wanted to say is like when you see that like a company like Berkshire is it can literally buy, what is it, 480 or
cash,
something crazy. Well, they have like 389 billion or something like that, but they can buy like the top I want to say like 475 or something of the S&P 500 companies with that money. It's like a staggering statistic that I just saw today. I don't remember the numbers very well, but like you're supposed to go into margin if you do that when Tesla's at 200, not when it's at 500. So, everything that we're talking about with options, just be very, very careful and be very clear. Like, we're not saying that you should be buying leaps and buying. It's the complete opposite. It's being cautious and being willing to maybe trim a little bit near the top and do something with a different strategy that has less risk versus increasing your risk.
I love how you said that at the end there, Xander. In the courses, the thing that I think the attendees hear more than anything from me is trade small and trade often. Like I say that nonstop to them. Trade small, trade often. I don't care if it's leaps. I don't care if you're selling or buy. I don't care what it is. No matter what it is, trade small and trade often. It's the only way to let the statistics work in your favor.
You guys have advice on what to do So why don't we start with, if somebody's not invested in Tesla yet and they're thinking about buying Tesla stock for the first time, what advice would you give them?
Well, I think only one of us here can give advice. I think only one of us have our Series 65 on this call. uh, so I won't give any advice. If I was fresh and I want to get into Tesla, honestly, right now, I would probably not get into it right now. I'd probably wait a little bit, see what's happening with the stock at these levels, and then maybe sell some cash secured puts and just wait for the stock to come to me. I don't know if the stock's gonna go up. I don't know if it's gonna go down. I don't like to time the market. I don't like to try to predict the price. I rather get paid until the market comes to me. And then that's how I would take my ownership in stock. That is how I buy stock.
Yeah, definitely not financial advice, but I would do exactly the same thing, is having the skill set to where you can sell some cash secured puts if you're trying to open a position. Is you can determine what's a fair value for Tesla here. Now, if you look at the forward PE ratios or trailing 12-month PE, it's priced to perfection, right? At 500, it's priced to perfection. So at some point they have to start delivering earnings. But by the same token, as we had the numbers, the delivery numbers released this morning, so we're recording on a Friday. So and you could see that the market doesn't really care too much about auto. You will have these option-driven payouts where the put buyers will do well, or the call buyers will do well, and it'll oscillate. But looking at things like trend lines is really important. So if you look at from April trend line until today, we should kind of bounce at 420. Today we were at a 445 50-day moving average. So I like to open positions when we're trading around the 200-day or below the 200-day, right? So there's a thing called the golden cross and the death cross, and that's when the 50-day moving average crosses the 200-day moving average. So understanding those simple concepts, that when a stock is running, is it really the best time to be opening positions? So that's something that I learned from the 2019s till now, which is when Tesla goes parabolic and goes to well above the 200-day moving average. Generally speaking, over a long enough time frame, most stocks, and CERN can speak to this probably way more and concretely, is they return to the means. So I would look at that. I would look at the history and obviously educate yourself on it. Tesla isn't really about cars. It's all about autonomy, and that autonomy enables robotics, because the same cameras and brain and the same computer that drives FSD is what will change the planet and how we do stuff with robotics.
Nice. And then, do you have a different opinion or same?
Well, I think the overall observation I would have here is listening to Zander and Nick. Clearly, there's a lot to learn here, right? They've thrown out a lot of terms that if you're going to play in this space, you need to understand. It takes time, it takes effort. It obviously can be very worthwhile if you're willing to dedicate the time. And I think the first step is to understand in yourself whether or not you are that person that is willing to do the work to understand this, right? And what I've seen in the past is some people get very interested in this, and then their life gets busy, and suddenly the positions that they put on, they neglect, and suddenly they're in a bad position because they haven't been tracking them in the way they need to be tracked, right? It's a bit like if you're going to be a farmer, you've got to be a farmer. You can't be a farmer and do something else. You've got to make sure that your crops and your animals are tended to. If you don't, you're going to have a disaster on your hands. Same kind of thing, I think, with more active trading strategies. And the key thing is understand, are you capable of being a farmer, right? Is that in your DNA? Do you enjoy that? Do you enjoy the discipline of doing that? If you do, then this can be very interesting for you. If you don't, then you're probably going down the wrong path.
What was the original question of somebody was about to think about Tesla? What's your advice?
Well, again, I don't want to speak specifically. I can't give investment advice in this forum. investment advice can only be given when, when I know a client's full situation, right? And with your viewers, I don't know who's watching and what their situation is, so I can't give anything specific. But again, I think the first part of this journey is to understand what you're looking for and who you are and the way you want to approach investing. There's many different ways of doing this, right? And whether it's Tesla or not, I mean, maybe you shouldn't even be investing in Tesla in the first place, depending on your situation, right? We don't know that.
Can I offer if we can just kind of, and I agree with everything Stern was saying, but look, I'll do a soft plug. If you are still interested and this does pique your interest, like I said, I teach this once a month at this point, and I'm going to be doing a 0-day option course soon. But Stern's spot on. It took me 10 years to learn everything I know with a lot of mistakes. And I think Xander, same kind of thing, right? So you don't learn how to ride a bike without falling off.
Sure.
Yeah. But I want to kind of switch the if it's okay with you, Herbert, just kind of a different framing of the bull case for Tesla, what I see right now. And this is, Xander, why I don't think Tesla necessarily needs to really be showing earnings just yet. This is how I see the landscape with AI right now. We've had a entire economy that is being propped up by AI investments. Now, I don't like when people say, well, if we didn't have it, then we'd be negative GDP and all that. It's like, okay, first of all, you don't know that because you don't know where that money could have gone or what it would have gone to. And second of all, but it did happen. So it's irrelevant. It's a what about or an if statement, which is irrelevant. The fact is, this is the reality we live in. But the other reality we live in is that we've got companies like OpenAI and Anthropic, which are not profitable companies with really high valuation that is almost reminiscent of what happened to private market in 2022, where a lot of these companies really had to get a re-rating. And OpenAI is seemingly trying to go public in order to raise capital because, in my opinion, they're over their skis now from a valuation perspective. And not to mention the space that they're in is getting commoditized and it's becoming kind of a level playing field faster than I think any other technology in the history of our lives. So I find that very interesting. And so as we go into as we're in 2026, I think people still believe that AI is going to continue to proliferate, but it may not be the LLMs or the agents that are the real money grab, right? They may not be the Amazons or the Googles that come out. They might be, just the HP or just the Dell or just the Cisco, which Cisco was great at one point, right? Just like OpenAI was, but then it kind of gets commoditized away. And so I think 2026 is about the companies that have true moats. And if you really think about it, Tesla, even bigger than NVIDIA, is the only company when it comes to real AI that have a true moat. And that moat is not anywhere close to being disrupted. And you'll see signs of it's about to be disrupted when other companies start putting the proper equipment in their cars, collecting the data, and building out the data centers. Not to mention anything else about having the talent and making all the breakthroughs Tesla had to make through internally that they didn't bother to make white papers about. They just figured things out. But once you see them actually doing those things, then that moat might be starting to get disrupted. And I think 2026, as cybercaps start to come out, as they start to launch new cities, I think Tesla will benefit from this moat because people want to put their money into the AI plays that are going to actually print money. I really don't think it's going to be LLMs. I think we're moving into a world where it's going to get, especially if you see some of the announcements that Amazon just made in December, you're going to see it a lot easier for companies to train their own LLMs, be able to inject in the pre-training phase before actual training ends, instead of just using RAG type models or agents that have access to other repositories to influence the data. We're getting to a whole different place where this is getting so commoditized, but you're not going to commoditize what Tesla's doing. NVIDIA is the only other company that I see right now that would be in that same kind of playing field, right? Because while I don't think NVIDIA has a moat like Tesla does, NVIDIA is still the place to go to. They're still the company to go to. People talk about Google and TPUs. Look, it's amazing what they're doing, but even then, the guy who really created the TPUs created Grok with a Q that now NVIDIA has him. Like NVIDIA is definitely fortifying their moat, and on top of that, with CUDA, NVIDIA's got a really good moat. So I think 2026, people are going to move away from just any company that just says AI in their name or any product, and they're going to start to see what Tesla's actually doing, and they're going to see that NVIDIA is still dollar for dollar the cheapest AI company out there. Feel free to push back, guys. It's okay.
No. I was going to ask that question about Tesla in 2026, and you're saying this could be the year that people realize that Tesla has a moat and they're ahead in real world AI. There's a few voices out there that started to say the same thing, which is, the last several years was about building AI in the first place that exists and it had and actually will be productive work to economy, and not a fad. And then it became everybody's buying it, and so we all need to get into it. And then the power of the LLMs. 2026 could be the year of, okay, well, what else can you use AI for? And it's, real world driving. That's what it is. Here it is. Could be interesting.
Yeah. The biggest beneficiaries of LLMs will not be the LLM providers. That's the funniest part. Yeah. It's going to be all the other companies that use Nella. It's going to be the four of us as we use it, right? We're going to get immense productivity and ROI on our investment for the subscription, but those companies are not going to get, in my opinion, the return. And this includes XAI. I don't see, unless they find a way to really find some other way to differentiate themselves and have another profit engine. I mean, that's the beauty of Tesla. While autonomy has this moat that no other AI company has, Tesla still has a auto business, an energy business that is printing money like crazy. Microsoft, they still have a whole other revenue generating arm. Amazon has these other revenue generating arms. All these other companies are profitable despite AI, right? So, but when you look at OpenAI, when you look at Anthropic, when you look at XAI, those companies don't really have that. Now, maybe XAI does now with the acquisition of X. I don't really know the numbers there. I don't know how clear that is. So that could be where XAI becomes kind of like Meta, where Meta kind of gets away with that. But all the other ones that were the first movers, I really don't think I don't think in 5 years from now, they're still going to be standalone companies.
Yeah, the XAI opportunity is interesting. I think their ultimate opportunity is this macro hard initiative, which effectively eliminates Microsoft software from the planet.
Don't tease us. Tease us.
If Elon can achieve that, then I think that's interesting.
Shouldn't have bet against Tesla, eh?
Yeah,
Billy boy.
The other thing I think to think about in relation to this conversation about AI and so on, one of the things that I've been thinking about and I'm a bit worried about is we're going to have all these AI agents. And we may be okay with XAI being our AI agent. We may be okay with OpenAI being our AI agent. Are we okay with Russian AI agents wandering around? Are we okay with Chinese, North Korean, you name it? How are we going to constrain AI? Right? AI is not something that's going to want to be constrained naturally. Right? It's going to work tirelessly 24/7 to break into whatever system it wants to break in to do whatever it's commanded to do. So we need to find a way to constrain AI. And I think that thing already exists. Right? And I think that is going to be interesting as people start to realize that we already have a technology that is sitting there waiting to constrain AI, which I think is badly needed. We don't need more rules and regulations. That's not going to work. Russia doesn't care for our rules and regulations, nor does North Korea, right? So this is also an interesting avenue in terms of, from a Tesla perspective, I think the real world AI position is unassailable at this point, right? And their moat is actually widening. The next point, we're not seeing other companies build the data centers that Tesla is. So anyway, some interesting things to think about.
And until you do, again, it's kind of, it's like the whole Sputnik Russia era, right? Back in the 60s. There's some things you just can't hide. Now, you don't know how much of it's for show or if it's real or not, but like there will be signs that you have competition. And until you see them building the data centers, until you see the vehicles with the cameras needed and all, like there's no competition. Like you need to have all that. But CERN, I have a question for you. When you say that, like, help me understand what lens you're talking about when you say, do we want Chinese agents out to do we want Russian agents? Are you saying like from a aggressor, like a vicious malware, attack point of view, or are you just saying in general, do we want to trust because they might have nefarious actions kind of thing?
Every single level you can imagine.
Okay, well, because I was going to say, like, because this is already done a lot in the industry, in the tech industry. Twitter was actually one of the first ones to really hard enforce against OpenAI, where they shut their API down essentially from OpenAI, so they couldn't scrape the data there, and you have to pay Twitter an exorbitant amount of money to be able to access their APIs, or they'll do API throttling, right? So there's lots of mechanisms companies use already. There's certain countries that companies will ban all web traffic from touching them. They'll block anyone who's accessing their sites from a VPN. So I think from a networking perspective, we have a lot of good best practices already out there. It's just making sure that companies enforce them. And the craziest thing, so many companies don't. So many companies have their APIs open wide where you can just go and ping it nonstop all day. But I do think the world's going to have to change when it comes to that.
Yeah, my perspective is that AI is not going to care about your permissions and your logic that's behind that. It'll find a way around it, and that's the constant game of whack-a-mole I think that we've been engaging in. Right, we're kind of in a cyber war, 24/7. Right, and that's not going away. And with AI, it's only going to make those challenges worse. Anyway, there's some interesting things to think about. I think from we're all excited about the development of AI, but we also need to be thinking about the other side of the coin in terms of constraining it. And that's going to be, I think, an important theme as we head into 2026.
Just to maybe steelman the other side, I actually do think you want Russian agents, Chinese agents, Iranian agents, Korean agents, North Korea. I think you want all these other, I think you want everyone to have an AI, because if you only have what we consider one or two good AIs, then that could run the risk of us being blindsided by one of those two good AIs being nefarious. And so when everyone has an AI, it kind of helps keep the checks and balances in place, if that makes sense.
Well, great conversation. So I think, if I had to summarize how I see it is Tesla stock is a disruptive technology. That's why I invest in it. And if they accomplish what they, these goals and these dreams, so one day we're going to have self-driving cars. One day we're going to have 1 billion humanoid robots. These are outrageous dreams. But if they do, and as CERN has done the work here, the market is so massive, they happen to be the largest markets on Earth ever, right? Then that's why you're betting on it. And so what happens is, if you're a buy and hold investor, there's, again, nothing wrong with that. CERN showed you that if you bought it at 22, again, you can't just be looking at past return, doesn't mean future return, but it's the same thing, the same story with some of these Mag 7s, right? These are innovative companies. If you invest in an innovative company and if they continue to innovate, there's a good probability that it's going to strike gold and they're going to succeed. You hold it, then you succeed. However, Tesla is a very volatile stock. And CERN has shown that many other stocks are actually quite volatile, but Tesla is very volatile for a number of reasons that we've covered before. And because of that, for people who study and, don't be afraid of options, it's not the devil, but if it's a devil if you don't know anything about it. But if you learn about it, then there's an opportunity here because it is so volatile. Would you guys kind of agree with that kind of framing?
All right, let me push back, because when people hear volatile, they hear that with a negative connotation. Volatility is good for you. Volatility is good. No growth company is not going to have volatility.
Yeah, that's my point.
Meta just went from 748 all the way down to 590, and now they're back at 650. That's volatility. All right. NVIDIA hit 200 something, went all the way back down. I don't know off the top of my head what it went all the way down to. Palantir, same thing.
180.
Yeah, Palantir, same thing, hit 200 something, went back down, right? So if you want a growth company and you don't want volatility, you're investing in the wrong company.
That's my point. That is exactly what I meant. Yes.
So I love volatility, especially as an option trader who predominantly sells options. Volatility is amazing.
Yeah, and I was going to add that same point is that on a day where Tesla's red, my portfolio is green.
Exactly.
Because of options. And the options allowed me to actually hack my brain to where I wasn't all sad watching the stock price, because I saw that we kind of like flipped over and we started downtrending, right? Like when Tesla had 2 red days in a row, and you look back over the last however long it's been, and there hasn't been 2 red days in a row, that kind of gives me like that, like, yeah, now it's pretty safe to get a little bit more aggressive with covered calls, which then, you have green days and you're happy about the green days, which actually gives you the conviction. Well, it gives you the ability to just sit through a drawdown, because you don't know how deep those things are. So I love the volatility, but another thing is, don't get me wrong, I'm all about Tesla. I can't wait to just fully deploy and just sit back and just let it run. Because like right now, I've just been conditioned to see green and take green, because this thing is just chopping around all over the place. I think CERN made a great point. Like, if you were betting that it's going to keep going, like some of the people who sold in the 200s and the 300s, and then you miss this giant run, you're not happy. But by that same token, if you see this giant run and you don't, create some buy the dip money, because you're all in and you don't have new dollar cost averaging money coming in or whatever. That's the reality. Is like, I would much rather see Tesla sit here, bounce around for a long time, allow me to grow the position, continue to earn money from the businesses, and then deploy and then have it run, get re-rated to 600 or 700 or 800 or whatever the crazy numbers people are putting out there. But that's the kind of the warning that I give to people, is just like, as you were saying earlier, this FOMO based trading or this fear based trading, it's none of it is cut and dry. I've really taken a little bit of everyone's styles and kind of made my own style. And if you are interested in it, that's what I've been trying to tell everyone. It's just like, options changed my life. It changed my family's life. It's allowed me to retire my parents. And it's one of those things where I say it's worth educating yourself about, so that in like 5 years or 10 years or however long it takes you, you'll have the tools to make the right move because if something happens. Like, I've raised some capital, and if we go into a, let's say, recession, I have some capital to deploy to maybe buy some puts, and I have some capital to buy the dip. And so like that's really all kind of, what inspired this episode, was kind of just share some of these lessons that I've learned along the way, and just, teach yourself. It's definitely worth understanding why this tool exists.
Can I say 3 real quick things, Herbert? One, thank you all for inviting me into this covenant of Tesla bulls. But first of all, I love a lot of what CERN and Xander has been saying, and I love looking at Herbert. But something that, you talked about the emotions of things, Herbert. One of the things that comes up a lot whenever I talk to people, just one-on-one, about their investments and how they're feeling in Tesla, where I get DMs nonstop. And even on X, you'll just see posts. But when we're at 498, and people see that their portfolio hits an all-time high, And then now we're off like 10 something percent from all time highs. And people feel bad. They feel like they have lost money. And there's this almost perverted sense of if we're not at all time highs in your portfolio, then you've lost money. That's just not the truth. Your all time high in your portfolio is probably not your real portfolio value. And whenever you're having a big drawdown or whatever's happening in the economy, that's probably not true either. So like, don't get that all mixed up in your heads, is what I would say, going back to the emotional thing. Like, markets are cyclical, stocks are cyclical, your portfolio is going to be cyclical. So don't let the highs get you too high, the lows get you too low. Just understand that the truth is somewhere in the middle. And then I was just going to defend CERN and me real quick. I think it's just our lighting. We both live in Florida. For now, CERN's bailing on me. We're tanner than this. These two jabronis are not tanner than us. So I don't know what is happening here. And then
you wanted to make that point? Okay, that was important.
Yeah, it was just, I'm sitting there, I'm like, what is happening here? I look pale. I'm Hispanic, guys. I'm dark. Okay,
I've
not
met
like
certain
this.
person. No, dude, it's.
All right, maybe CERN's not our best example in Florida. But the other thing I was going to ask CERN, which I thought you would have a chart on this, but did you guys know that Tesla's tied right now for its longest daily losing streak?
Yeah, 5 days, 7 days, 8 days.
7 days.
7 days. Today was the
It had to hit eight to be tied.
I don't know, but I thought CERN was gonna have a chart on that. So
yeah.
I was curious if you do maybe have one hidden back there in your back pocket or something.
I can make one. Do you know what the longest daily win streak is?
For
I don't.
Tesla?
12 or 13, or is it 14 now? It was just recently established.
So it follows then that the longest win streak is followed by the longest losing streak. Huh?
That's interesting. Gotcha. It makes sense though, doesn't it?
Okay, good. I mean, yeah, so the goal of today was to share different people's different styles into, and again, I don't think anybody would say one
Nick's
style
course.
is
That's what it was.
pump Nick's course. No, I mean, it's it's share different styles, and if people do want to learn, they should learn, and so they should research this, and that's actually a good service.
Well,
but
look, just to address that real quick so that people don't think I'm a complete douchebag. The reason I talk so much about the course now is because I don't want to talk about options and people hear what I say and think, oh, this is so easy. I'd rather like always kind of caveat like, hey, I'll teach how to do this before you go and do it, because I don't want that on my conscience that someone goes and does something stupid, like I mentioned before, and they make the mistake that Xander made all those years ago, that I've made before, that pretty much everyone who's ever gotten the options made at first. So I just...
Yeah. And I'll tell you, the only margin call that I've ever had, which was 3 of them in a row.
How fun was that?
Yeah, it was fine. It was fine. It's just like being audited. I've been audited too because I didn't make any money when I was opening my business. It was hysterical. I showed up with like a baby stroller full of all the files because I have everything, all the invoices, everything's perfect. But anyway, it was because at 415 and then we were at 350 and 300 and you're selling cash secured puts, or maybe just puts utilizing your portfolio margin abilities. My calculations were that Tesla wouldn't go below 200. So at that point, all of the sudden, you can over leverage your portfolio margin abilities, because during volatile times, they can raise your the margin requirement, and so that's why I say it's. You have to know what you're doing if you're going to do it. But there are things within the options world where you can be, if you're selling cash secured puts, you can't get margin call because it's cash secured. If you're selling covered calls, it's a covered call. It's just you're willing to sell your shares at a top or at a bottom. So, lots of experience of all the bad times. But 5 years later from learning options, I continue to love it. And now it's actually life-changing.
Okay. Sounds good. And then, CERN, do you want to just reiterate, right? I mean, not everybody has to do this, but if they held the stock and you don't know which days it's going to go pop, Just hold it if you believe in the company. If it's an innovative company, hold it. Sell it if you think that they've lost, your thesis has changed. Otherwise, nothing wrong with that for some people.
No, there's nothing wrong with that. It's interesting too, the mindset shift that happens. If let's say all companies were private, right? And you could only make a decision to buy a company and own the shares. And then maybe once in a long time, you get an opportunity to sell a private company, right? But we have this public stock market. And now a lot of people think that because this stock price is every day, every minute of the day, that they should be doing something. And for most people, the answer is they should do nothing, right?
It's funny you say that.
Sit on your hands.
That same mentality I've kind of seen in the housing market. I know this complete apples and oranges, but with Zillow and their Z estimates, people will not sell their house now, even though they want to move, because they're like, well, it was worth this back in 2022. Yeah. Now it's not. So it's actually, and they're stuck with that. And it's kind of funny. You're right. In the past, you didn't have this constant update where you can go on like, oh, what's my house worth right now? So it's funny.
Imagine if there was a ticker tape above the garage in your house, so you pull into your house
Warren
every
Buffett
day.
said that, guys. That's his quote.
That's right.
Yeah.
Warren Buffett's quote. It's not like somebody's yelling at you in the outside street telling you what your house price is every day.
Personally, I would love that. Yeah. Personally, I would love that because every time I do an update on the house, they're like, all right.
Should have gone out. Yeah. Awesome. That was fun. Thank you. It's a different kind of CyberBulls show. A lot of our viewers are investors, and there's a segment that are full buy and hold, and then there's segments who want to learn how to play with options, and then of course there's just understanding your financial situation, of course, and everybody's different. So the more you learn, I think that's the message from you guys is learn. It's always the best because it's money.
We're not that different. We all want to make more money.
Herbert, this isn't a different style. It's an old style of CyberBulls, except with no audio issues like we had.
This is how we started. Yeah, different investment styles, and we shared how we learned from each other, right? Yeah. Thank you so much. Thank you, Xander. Follow him on his X account at R6Alex, and then
we're ending.
We are, yeah.
Oh, I was having fun. I was like, all right, we're just getting started. I can go another 2 hours.
We can do an after party after I shut down recording. Then, you know what happens after the
I could
after
talk
parties.
this all day. I could talk about this stuff all day. So
Nick Gibbs, IAG, and he's got a website, YouTube, Investing Against Grain, a new podcast, Behind the Trade. Check him out there. And of course, Cern Basher, brilliantadvice.net. Thanks, everybody.
But not advice.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.